All right, thank you very much for including our paper in the program. And this is a paper which is going to be about robo-advisors and access to wealth management. And it's a joint work with Michael Recher from UCSD. And I am here, Stanislav Sokolinski, this is me. So when I will be talking about our paper, I will try to link it to some other papers which were already presented. Okay, what I have in mind in particular is the paper by Stefan on the role of financial advisor in retirement savings, and the paper by Philippe on biases of financial advisors. Milo will present his paper himself. I won't spoil it, but our papers are also interrelated. And when I'm thinking about the previous presentation by Ankit, I think our paper will probably emphasize sort of the bright side of the technology rather than the dark side of the technology. So the starting point is that less wealthy investors receive less professional assistance when they're making their financial decisions. And you can think about a couple of reasons of why this would be the case. Okay. One reason is that they simply lack demand for professional wealth management. Why would it be the case again? They can be self-sufficient. If you think about any classic models of portfolio choice, you don't have any professional assistance or any wealth management in these models. Investors just do investing on their own. The other reason might be that they don't understand the benefits of having professional assistance. And the third reason is that they might not trust asset managers or financial advisors, any wealth managers or any other type of professional assistance that you can have in mind, and that's why they don't do it. The other story would be that less wealthy investors want access, want to have some professional assistance, but they simply cannot get it, okay? And the leading reasons for that is large account minimums. So, for example, in the US, if you would like to have some professional assistance in form of financial advisor or wealth manager, you need to bring a sufficiently large amount of assets to begin with, okay? Otherwise, it will be hard to get any professional assistance when making your investment decisions. So this is the point where robo-advisors come in, okay? And what they say they do, they argue that they promote access to wealth management. If I need to name, three most important trends in asset management over the last 10 years, I would say passive investing, okay, which many of you heard about. I would say target date funds, which also many of you probably heard about, and I would say robo-advice. Okay, robo-advice is growing very fast, and there is a tenfold growth over 2015, or 2015-2020, and they seem to provide diversified, personalized, and rebalanced portfolios. So this is indeed professional assistance in making investment decisions. But most importantly, they argue that automation that they use lowers cost to accommodate smaller portfolios. They are basically saying, well, we can provide access to professional assistance for smaller investors. If you just Google robo-advice and democratization of finance or democratization of wealth management, you'll find so much Google search data about that. If I need to summarize it in a few sentences, right, I will take a quote from The Economist. The wealth management industry stratifies customers like airlines. High net worth clients fly business class, chatting with named advisors. Cattle class gets no service at all. Technology is conspiring to change that. Okay, cattle class is a British slang for the economy class. I didn't know that when I read the quote, so I learned something about that. So it sounds like very popular and intuitive idea. Okay, yes, there is automation. There is this new type of asset managers with much lower per portfolio costs. Probably they can provide investors with access to professional assistance, but let's take a look into this argument more carefully, okay, from the empirical perspective. So I would say it's a popular argument, it's an intuitive argument, but not tested empirically. So this is where our paper comes in. And what we do, our setting is we have a quasi-experiment, which is a reduction in account minimum by a large US robo-advisor. I will tell you exactly who the advisor is, okay, when we get to the data part. The reduction is from $5,000 to $500 in July 2015. And this is a large reduction because the median US household has 17K in liquid assets. Using this setting, we are going to address three questions. First, does the reduction increase robo participation for the less wealthy investors? Okay. The second question is, if so, what drives demand for robo-advice? And here we have two different stories in mind. One of them is more of a behavioral story where people have some preference for using new technology, or maybe they want to have professional assistance because they need peace of mind. So what I have in mind is a money doctor story where investors need some hand-holding to be able to make risky investments. The other story would be more classic, and the idea is that robo-advisors can offer better portfolios than the homemade portfolios that investors design on their own. So that would be the reason for going into the robo-advice and joining the robo-advisor post-reduction, because you can just get access to better portfolios. And finally, we will talk about welfare gains to investors. Okay, we are actually going to impose a life cycle model of portfolio choice on the data, and we will use some counterfactual analysis such that we can say something about welfare gains to investors from transitioning from self-management into robo-advice. So let me give you a preview of the results before we dive into the paper. So the answer to the first question is yes. So robo-advice democratizes the robo-market. I mean, the reduction democratizes the robo-market, but bringing in middle-class investors. So what we find is that middle-class investors are 15 percentage points more likely to participate with a robo-advisor after the reduction. We don't find effect on the least wealthy. I will define the least wealthy when we get there, but we don't find any effect on the investors with the smallest amount of assets, which can have some implications for wealth inequality in the long run, if you want to think about it later on. The answer to the second question is that demand for robo-advice is driven by better portfolios. Okay, so basically our life cycle model of portfolio choice can closely match the change in participation across the wealth distribution when we just plug in the portfolio differences. Okay, and I will show you how we do that. So we don't need any extra assumptions on, let's say, stock market participation costs, or we don't need extra assumptions on like peace of mind or any other behavioral parameters to match the data. What are the differences in portfolios? There is an exposure to multiple risk factors. Here it's becoming a little bit more like financing, okay? Risk factors such as value and size. So the bottom line of this finding is that robo-advice is not an equity index fund, okay? There is more than that. Second, what we find is portfolios also vary by age and wealth, okay? So that's something which we call double glide path. And it means that robo-advice is also not a target date fund, because target date fund offers a single glide path by age. So for those of you who don't know, target date fund is a popular retirement investment where portfolio automatically, as investor ages, the portfolio automatically adjusts with more bonds and less stocks. Basically, that's the idea. And there is also much better diversification. So if you look into the idiosyncratic risk, differences in idiosyncratic variance among the portfolios, there will be much less idiosyncratic variance in the robo portfolios. And when it comes to welfare, we find that welfare gains are moderate, okay, but heterogeneous. And older investors are having actually the largest gain. So that was something that we were surprised. But when you think about this more carefully, you realize that when we will get to the results, and I will hopefully explain you why older investors are having higher gain. Yes, Milo.
Yeah. When you talk about personalization by age and wealth, are you implying that the other dimension that the robo is taking into account do not matter, like risk preference and so on? Or?
So risk preference matters, so they pick up your risk preference from the questionnaire, and I will explain how it works, okay? But conditional on that, people of different age and different wealth will get different allocations.
Yes. So this is I'm trying to understand how to interpret that sentence. You're saying, okay, also people with different risk preference will get different allocation.
Yes.
But why is not mentioned this because only age and wealth are the key.
Because it doesn't affect the amount. I mean, so you've got 3 factors or more. He's saying two have an effect, and the other one doesn't.
Exactly. So this implies that the other effect do not have, the other dimension do not have an effect.
So it doesn't, no, so risk aversion matters, but I think it's easier to explain when we get into the data. But in the data, so what you find is that the answers to the questionnaire on the risk tolerance are not so different across different investors. So ultimately, they have, most of the investors are getting kind of the same risk tolerance.
Most financial advisors ignore the risk tolerance, and they do it because they're supposed to. Anyway, that's okay.
Can you say a few words about this democratized? Democratized is a big word, right? Do they, at the end, do they really get a good service, or are they still in the capital class? And so, is it about, inclusion and participation, but, does it really help?
It's not about participation in the stock market per se, because many of our investors already participate in the stock market and they have some homemade portfolios, okay? But it's about portfolio improvement, okay? So the portfolios are getting better, okay? And there are welfare gains from joining the role.
And it's mostly diversification? They get better diversified?
So I will show you, so there are these 3 different dimensions, right? Exposure to different risk factors, personalization, and diversification. And when we do the welfare analysis, I am able to run different counterfactuals. I can strip, let's say, diversification or personalization, and I can see what the difference in welfare gains is. And I will be able to tell you what matters more, okay? Yeah, so that's the welfare, that's the benefit of having some model and having, some welfare analysis. All right, so I will talk about the data, okay, and then basically we will deal with the first question using the difference in difference approach, and I will show you how we design the specifications. And then to deal with the other questions, to what extent difference in portfolios matter and what are the welfare gains, we will use the model, okay, to address these questions. So let me talk about the data. The data comes from Wealthfront. As of 2015, that was the second largest US-based robo-advisor. So let me give you some differences, how Wealthfront differs from robo-advisors that were used in these other papers. So it's not, all of these tools are different, okay, at this point, and there are many different types of robo-advice, so I think that's worth to clarify what Wealthfront is about, but also will connect to some of the papers that were presented here. What I have in mind is paper by Stefan and paper by Philippe, and there's paper by Milo as well, but I won't spoil it, okay, Milo will present it himself. So first of all, it's not a recommendation tool, okay, so many of these robo tools are basically providing investor with some suggestions, which investor can take it or not. Investor can decide that they do something on their own. Here it's not a recommendation tool. The advisor gives you the allocation, you take it or leave it. You cannot change your portfolio weights, okay? You just have, if you want to invest, you have to take what is offered, okay? You cannot, it's very paternalistic in this sense, you cannot change the allocation.
It's like choosing a managed fund.
I'm sorry?
It's like choosing a managed fund.
Pretty much, yeah, okay? So that's, we can think about advantages and disadvantages of having that in mind. So maybe it's not such a bad idea not to allow investors, to make too many decisions on their own, okay? As we can see from Ankit paper, for example. Another thing, there is no option for human-based advisor, okay? So you cannot talk to anyone. It's fully online, it's fully automated, there is no human-based advisor, and you cannot talk to other people, okay? And it's also not affiliated with banking system, okay? So it's an independent company. Everyone from any bank can come and open an account and invest, okay? You can just Google it right now, and as we speak, you can open an account with Wealthfront. At some point I tried, I went through the process myself just to see how it works. So, how the process works. So the process, basically, the investment process consists of 3 parts. The first part is, they profile the investors. There is a questionnaire, how old you are, wealth, income, wage, report your liquid assets, and the questionnaire about risk aversion, okay, which is fairly standard. Then the questionnaire will determine the portfolio weight across 10 ETFs. okay? And these are the same ETFs to all the investors, so we will all have the same portfolio of, we will be exposed to the same risky assets, but the weights are going to be different, okay, based on who we are. And it's all passive, there is no active investing, there are no individual stocks, no individual securities, just 10 ETFs across 10 different asset classes. So you might have in mind US equities, international equities, US bonds, international bonds, real estate, and we'll talk about the ETFs in the paper. And then what they do, they will rebalance the portfolio for you automatically, okay? So there are weights, okay, and every 3 months they will rebalance, okay? Now, when it comes to fees, the management fee is 0 for accounts below 10K, okay? So they take nothing from investors, from smaller investors. And the idea is that eventually they hope that smaller investors will cross the 10K threshold and then they will start paying the fee. Otherwise, it's 25 basis points. On top of the management fee comes the fee from the portfolio of 10 ETFs, but because these are the cheapest ETFs on the market, mostly Vanguard ETFs, the weighted average fee on average is 12 basis points, okay? So if you are a small under 10K investor, you just pay 12 basis points per year, okay? And if you are a larger investor, you will pay 25 plus 12, which is 37 basis points. So where does this process take us, right? So comparatively to other papers, right, that we have seen. So there is no preference of the advisor imposed on the investor. Okay, I'm talking about Philippe's paper, right? So it's all automatic, okay? You might think that there are some preferences in picking up this initial portfolio of 10 ETFs, but these are just the cheapest ones on the market, okay? That's at least what the advisor says. And there is no conflict of interest, okay? I'm talking about Stefan's paper, you know, you don't have any commissions, any kickbacks, anything. Okay, so that's, in many ways, I would describe it as a very sort of innocent way of offering wealth management / financial advice. All right, so what data do we use? So the main data set...
Conflict of interest, they don't get any payments if they recommend this ETF rather than that.
Yeah, so we will all have the same ETFs. You will have the same 10 ETFs, I'm going to have the same 10 ETFs, but the weights are not going to be the same.
No, but my point is, let's say there's one that's paying them, and then so they'll put everyone 90% into the one that's paying them.
No, they will just buy on your behalf Vanguard ETF on the market. Okay, so that's what they do. So the main data set is deposit data set, okay, which is a panel of client weekly deposits from 14 to 16. The reduction in account minimum is in the middle in 2015, and then there are other data sets which are mostly standard. But the important one is the portfolio data set, which is slightly different from the deposit data set, which I will describe when we will talk about the model and the calibration of the model. So there are some caveats, okay, because I will be only able to observe people who are in deposit data set, okay? These are people who are eventually will join the robo-advisor, okay? So then when we do the analysis, we will have to be careful about the interpretation of the coefficients, okay, because I will only be able to say something about a certain sample of population, okay, who eventually joined a particular robo-advisor in the US. Okay, I won't be able to tell you more about whether it will hold for all investors in the US, whether it will hold for other investors outside of the US. Okay, so the interpretation will be narrow. So let's look into a sort of basic descriptive result, right? So what we do here is the following. So on the x-axis, these are the 5 quintiles of wealth of the US wealth distribution, okay? And on the y-axis, this is the percentage of participants, fraction of participant from each quintile of the US wealth distribution when we are comparing the existing participants, those who were the clients of Wealthfront before the reduction, and the new participants, those who were the clients of Wealthfront after the reduction. So to determine the quintiles, we go to the SCF, which is the Survey of Consumer Finance 2016, and then we pull the data on liquid wealth. We calculate the cutoffs for the wealth distribution. So the cutoffs for the bottom quintile is $1,000. Okay, the two middle quintiles are between investors who have between 1K and 42K. Okay, and then those who have more than 42K are in the top two quintils. Okay, so we do not determine middle, we do not determine the wealth distribution, the cutoffs based on our data, but we rather go to the SCF and we say, okay, SCF give us the cutoffs. Okay, I don't want to come up with the cutoffs myself. So what do we see? So basically it shows that after the reduction, there is an increase in the new participants are more likely to be from the second and the third quintile, from the two middle quintiles, okay, and less likely to be from the two upper quintiles, especially from the top quintile, okay. So the distribution of participants sort of shifts toward the middle class investors. By middle class, we mean the middle quintiles, and by upper class, okay, we mean the two upper quintiles. Now, here you can say, well, there may be a variety of reasons of why you see that, because middle class are younger, because middle class, all of the standard concerns, okay? So then let me actually talk how we tease out this result in a more rigorous way using different econometric specifications. So we do a difference approach. We estimate the effects of reduction on robo-participation. The time series variation is pre versus post, okay, and the cross-sectional variation is the middle versus upper. So middle class are the treatment group, okay, which are more likely to respond to the reduction, and upper class are the control group. The assumption is that the unobserved determinant of change in robo-participation do not vary across middle and upper classes, okay. The assumption of parallel trends, that there is no pre-transient growth in robo-participation for middle class relative to the upper class. And the second assumption is that there are no other effects that coincide with the reduction. So there is like a tricky, the second thing is tricky. I mean, the second thing basically says, look, we have this reduction, which is just the reduction in account minimum. It's a supply side effect. It happens on, the advisor does that on the supply side, okay? And we would like to estimate the effect of this supply side reduction on robo-participation. But at the same time, there might be some demand side effects which are happening at the same time and are stronger for middle class. So one such effect that people typically have in mind is advertising, right? So if middle class, let's say they advertise the reduction, okay, and middle class will be more responsive to advertising relative to the upper class for whatever reason, okay, and it happens exactly at the same time, that can also interfere with the estimates of the supply side effect, right? So that basically will mean the reduction still matters, okay, but it not only because of just the effect on the supply side, but also there is an extra effect on the demand side, okay? And then we will need to think carefully how we account for advertising, and we did some tests for that, which I will probably not show you, given the time. Yes?
Is there also a possibility of spillovers, like between middle class and upper class? Like if I talk to my middle class friends and they say, look at this great new product, and I'm like, wow, I didn't know about this. Like, that sounds a really sensible idea.
Yeah, so that they can kind of talk to each other, but for this, I mean, so one thing that how we think about that is that we can look within states, right? So we can interact with, let's say, with state fixed effects, right? And then we can see to what extent it reduces the coefficients that we use. Okay, yes?
I'm not sure exactly about the timing of the introduction, but there was also a referral bonus for wealth runs. This might get to your question, that they were able, if you referred a friend, then you got an additional $5,000.
At the same time.
I don't know when that promotion went into effect. I just know that promotion exists because I got an email from a friend at some point that was like, if you join, you both get $15,000, before the expense comes in.
So was your friend poorer than you or richer than you?
Well, I was a grad student at the time.
No, you're old.
Yeah, I mean, I didn't know about referrals, yeah, honestly. So
I don't know when that
I will look into the timing of that. If it was around the same time, I mean, that should happen exactly at the same month, I mean, to be more precise, to interfere with the results.
Yeah.
But we will check that. I mean, I didn't know about that. Okay.
Maybe I missed it, but is there an assumption about the 5,000 binding for any of these groups more than another one?
So
maybe the $5,000.
Yeah. So people typically the middle class will be defined in the broad ways. The investors between 1K and 42K. Okay. Now you might say, well, if you have like $40,000, okay, like why 5K? Why is it an issue?
Well, what kind of wealth is this?
Liquid wealth, which is like all the liquid wealth of your checking account plus saving account plus all of your risk assets. Okay. Now, in the model calibrations, we actually find that the cutoff is around 20K, okay? So the reason is that if you have 10K, why wouldn't you invest 5K? Because the risky share is going to be very high, okay? And you don't want a risky share of 50%, okay? So that's why we pick this very broad range of the second two quintiles. We also look into quintile by quintile. Okay, we will find stronger effects for the guys that have between 1K and 6K. Okay, not surprisingly. But there might be also people who have like 20 or 15K, and they will also be responsive because they wouldn't invest 1/3 of their wealth or half of their wealth in the risky assets before that. But more importantly, we do not want to look where the result is and then to define groups based on some cutoff that we find in data. But we would rather go to SCF and we will say SCF give us the cutoff. So that's why we are going.
It's also new technology. It's not just a risky share. It's do I trust a robo advisor?
Right. But eventually they will all become participants in our survey. Yeah.
So your data is conditional on people choosing to deposit into this.
Yes.
So presumably, if you were planning to deposit between, let's say, 5,000 and 6,000, right, we could plot over time, both before and after the change in policy, the number of people who deposited between 5,000 and 6,000, their attributes, whatever, right? And then you can do the same thing for 4,000 to 5,000, where there was nobody before and a certain group after. And then one question you can ask is, to what degree are we bringing people who used to deposit 5,000 but would really like to do 3 and moving them down? And then another question is, on the margin, how many people are being brought in who wouldn't have otherwise participated? So it seems like that approach maybe is the way you want to go.
So one thing that we did, I'm not sure that it perfectly answers your concern, but one thing that we did is we looked into sort of bunching, which is that, I think, which is exactly that, where we looked into the idea whether middle class are more likely to bring exactly 5K before the reduction, so they will kind of bunch around the 5K threshold, okay? But once you remove the constraint, okay, the bunching sort of disappears.
But let's focus on the middle class. I guess what I'm saying is talking about it is about the middle class.
Yes.
Isn't really salient. The issue is we're going to have two effects. One is we're going to take people who would have deposited anyways at 5,000 and instead they'll only deposit 3,000. So that's one change we're making. Another thing is there are people who would not otherwise have deposited because they weren't willing to put in 5,000. Now that 3,000 is an option, they're entering. Right. So 100% of what you're observing are a decomposition of how many of those folks are in those two bids, right? Like you can't really see anything else.
Right.
And then describe it.
So it's like a hurdle form.
Yeah.
Yeah, exactly. You've got two data generating processes.
Yes. Yes, that's correct. But within the people who eventually joined, I still have some variation versus who joins when. And that's the variation I will be exploring. But I think it still does not address your concern. I think we can think about this point. Okay. So bunching probably will not perfectly address that. Okay. So let me show the result, okay, and I will move into the event study. So we can do difference in many ways, right? There are many ways to do different things, okay? So one a bit more, I think, sophisticated way of doing that is to run an event study, okay, where the outcome variable is the new participant, and it switches 1 in the week when the investor joins the advisor, and then again 0. So it's 1 only when there is a switch in participation, when there is a change in robo participation, okay? Then we interact middle dummy, which is a dummy for the middle class, with dummies for each month before the reduction and each month after the reduction. So there are several monthly dummies, okay? And then there is this coefficient, okay, on mu, which basically estimates the effect of being in the middle class relative to the upper class in certain month. Okay, so we can run the event study month by month, okay, and the advantage of this methodology is the following. So first of all, we can test for the parallel trends assumptions. We can look exactly whether before the change in participation there is no effect in each single month. Okay, before the reduction there is no change in each single month. And then we can also visually see when the effect kicks in, right? And our assumption is the effect should kick in exactly in the month of the reduction. So what you see here is basically some confirmation of this idea. So first of all, there is no effect, okay, before the reduction in each month, okay, there is no change in behavior of middle class investors versus upper class investors, so the parallel trend assumption holds. And then in July 2015, exactly when the reduction happens, there is a sharp increase in robo-participation, in a change of becoming a robo-participant among the middle class investors. Okay, and this effect holds for the next 6 months. So our data has 6 months before and 6 months after the reduction. Okay, so that will be probably the best sort of visual and econometric-wise the best evidence on the effect of the reduction on change in robo participation. Okay. All right. So I will skip the advertising part, but we do look into the effects of advertising. We find that advertising interferes with the supply side effect to some extent. Okay. So we can reduce the effect of the reduction by further allowing for differential effects of advertising on middle and upper class, pre versus post. But it does not completely kill this effect, okay? So I will just give you the conclusion. If you want to see the analysis, it's all in the paper.
Can I connect that to my earlier comment? So advertising the number of people who would otherwise deposit $6,000 or $10,000 must be unaffected by this introduction, right? Because those folks, if they had wanted to go smaller, they could have always gone to 5,000. So anybody who puts in strictly more than 5,000 doesn't have a direct effect from this rollout, right? So you can look at the deposit behavior of people at 6,000 plus as a way of measuring advertising, right? Any change at the 6,000 plus deposits can't be because of its effects. There's no direct effect to that group.
Okay. So we can think about it. I mean, probably we will talk more about that, after the presentation, so I can kind of get to the bottom of your point. Okay. So thank you.
People could change their mind though. Like they could be lured into considering, like deciding to invest if the limit is lower, and then when they actually make the decision, they could then say 6,000. So it's not completely a zero, I guess.
Okay. All right, so let me talk about differences in portfolios and welfare implications. So here, after we have documented that the reduction matters for the change in robo participation among the middle class investors, we set up a life cycle model of portfolio choice, which is very standard. Okay, so I will only describe our new ingredients in the model, so what we change relative to the literature. And what we do, we add two risky assets, okay? We have a self-managed portfolio, okay? And then we have a robo-portfolio, which is different from the self-managed portfolio, but robo-portfolio is locked behind account minimum M, okay? So basically we impose our realistic empirical setup on the model, our setting on the model, okay? Or we impose the model on our setting. You can think about this way as well. And then the model will allow us to answer two questions. So first of all, can we fit the change in robo participation using the standard model of portfolio choice, and what assumptions need to be made for this fit to happen? Okay. And the second is the welfare question. So we can use the standard tools of portfolio choice models to measure the welfare gains, and then we can see what are the effects of joining the robo-advisor on welfare. Okay. So we impose a factor structure on risky returns. Okay. Again, a bit more of finance, I guess. The return on any portfolio is the function of price risk factors, which we have in mind. Typically, we have stock market, bond market, value, size. Okay, U.S. stocks. International bonds and U.S. bonds. So we'll have 5 factors, and beta is the loading on the factor, and epsilon is the idiosyncratic shock. So this is your idiosyncratic volatility. So basically, what it tells you is that why are the portfolios different? Okay, they can be different because the betas are different. Robo beta is not the same as homemade beta. Okay, they can be different because the idiosyncratic shock, idiosyncratic volatility is different. Diversification, right? That's what we have in mind. Idiosyncratic volatility of robo is not the same as idiosyncratic volatility of homemade portfolios. And they can also be different because we allow for loadings and volatilities to vary across households, because different households are getting different betas, age and wealth. That's what I have in mind. Versus robo versus self-made. So we use a different data set to do the calibration, okay, which is related to the main deposit data set, and this is a snapshot of self-managed and counterfactual robo-portfolios. So at some point, Wealthfront offered an online tool, okay, where the investor can log in, investor can give his details of his brokerage account, so they will pull all the data from his existing current brokerage account, and then investor would observe the robo portfolio that he or she would get if they decide to join. And within this data set, some investors will decide to join, and they will switch, and then they will arrive into the deposit data set that we use in the DID analysis. And some investors are becoming non-participants, so they will decide to leave and to go. Okay? And the advantage of this portfolio is that we observe both self-managed portfolio, thanks Philippe, and we also observe counterfactual, right? We do observe what people are doing on their own, what are the homemade portfolios and how they look like. So we took these portfolio pairs, there are around 2,000 pairs. We estimate betas and idiosyncratic volatilities from the previous slide for each portfolio, okay? Then we take these portfolio differences, okay, and then we project them on age and wealth, so we can fit different betas and different idiosyncratic volatilities to different investors based on age and wealth, right? This is the personalization aspect. And then we throw the fitted values into the model, okay? So let me show you quickly what the differences are. I think that is interesting on its own, the descriptive level. Okay, if you compare robo portfolios to self-managed, what do you find? So matched robo portfolio for the same investor, right? That's what the same investor would get if she switched to robo. The Sharpe ratio would be almost twice larger, right? It's 45 basis points self-managed versus 75 basis points robo. Okay. This larger Sharpe ratio comes from high expected return, 10 percentage points versus 8. And from much lower total volatility, 13 percentage points versus 20. And the much lower total volatility comes from like significantly lower idiosyncratic volatility. So there is almost no idiosyncratic risk in robo portfolios. Okay, it's all exposures to different risk factors and very little idiosyncratic risk. But basically, if I remove all the finance kind of jargon from that, people invest. If you look into self-managed portfolios, there are a lot of individual stocks. Okay. When they switch to robo, they just get 10 ETFs. Okay, and that's sort of the big difference of why the idiosyncratic volatility falls by so much. Okay, that's the story. Yeah.
So I had this question before, and you've sort of half answered it here as to how well your factor model spans the space of the individual portfolios. So have you tested alternative? It seems like your results here are dependent on your asset pricing model.
So we did 3 different models. In the main part, we do the 5-factor model with the 3 stock factors and 2 bond factors. We also tried only the 3 stock factors, and we also tried only the market, just the CAPM, okay? But we didn't go beyond 5 factors, okay? So, but you have in mind, like maybe individual investors also do some crypto, and we need to like add the crypto factor, or probably. I mean, it wasn't relevant then. Yeah, I mean, I see a point. So you're basically saying that maybe the universe of assets that they invest in individually, self-made, I mean, that was different from...
I guess another way I would ask, I think I asked the same question, but I'm not, is in your figure 4, you show how they map that risk tolerance voodoo thing, the survey, to the portfolios. So from that, you ought to be able to infer a relative risk aversion, something the rest of us understand, not a risk tolerance score. So what relative risk aversions are you inferring back when you then do this welfare evaluation, when you do this?
I see. Okay, that's a good point. We need to look into that.
So there are no risk aversions in here, or they're sort of hidden somewhere?
We do not infer risk aversions from our current analysis.
How do we do welfare evaluation in here?
We take risk aversion from other papers. We take risk aversion we take some benchmark levels of risk aversion from different papers, and we see how robust the results are to different gambles. Okay.
So the point is that in structural modeling, all the welfare measures are always dependent on your assumptions about
That's true.
the objective function. And I just think it's important to be clear about that in relation to the asset pricing model as well.
Okay. Okay. I mean, we are trying a range of standard levels of these conversions, so it helps to some extent, but I think we can do probably better on like teasing it from the data, as you suggest. So I will skip this. I will move into this slide, which is basically, I almost don't have time, so maybe like 2 or 3 minutes and I will finish. So this is the answer to the question, can the model explain the data, right? So we throw in the differences in portfolios into the model, okay? Then we reduce the account minimum in the model, and then we have some change in robo participation across the quintiles in the model, and then we compare it to the very first graph that I have shown you in the very beginning, okay? So the graph is the same, the red dots is the model, okay? The red dots is the fit of the model. So what we find is that the fit is pretty good by the standards of the literature. The model...
There's no standard errors on the model. Gosh, that's pretty good.
I'm sorry?
There's no standard errors on the model. That's pretty good.
I mean, we can add that, okay?
Yeah.
Yeah, I mean, that would be, yes. So I think that, yeah, so we can add like confidence intervals from both the model and the data, yeah. Already, we were thinking about that already, yeah. Now, we kind of undershoot a little bit here and overshoot a little bit here, but it's overall not a bad fit, and we can also fit other moments such as risky share, okay, and we can also fit stock market participation pretty well. So we went beyond this sort of basic fit, but we also tried to see, can we explain some other moments of the data, so the model looks a little bit more robust than just being able to fit the change in robo participation. And then welfare gains, okay. We use the standard approach in the literature. We look into the expected lifetime increase in utility from the reduction, okay? Then we assume, but when we say, let's assume that the minimum remains the same, and let's see what the increase in annual consumption should be to generate the same increase in lifetime utility as the reduction does, okay? And the welfare gains is this increase in consumption, okay? That's a standard metric from the life cycle literature. And we calculate these gains under many counterfactuals. So the headline number here is 77 basis points, okay, for the pooled sample for all the investors. And just to give you some sense what it means, 77 basis points increase in annual consumption. This is modest by the standards of the literature, and it is comparable to 1.5 percentage point increase in equity premium. Okay, so if you take equity 8 percentage points equity premium, okay, reducing the account minimum from 5 to 500 is the same as keeping it 5, but increasing equity premium by 1.5 percentage points. So equity premium goes from 8 to 9.5 percentage points. That will give you the same welfare gain. Okay? So that's that to have some feeling of what it means. There are differences across age groups, which are very large. Investors who are older than 56 are getting basically 3 times larger welfare gain relative to younger investors. And that mostly comes from the fact that younger investors, many of them will be able to overcome the minimum of 5K eventually sometimes, okay, in their life. So if there is a young investor with few assets, there is a good chance that they will be able to accumulate enough assets eventually at some point, so they will become robo participant even if the reduction doesn't happen. Okay, and older investors at the age, let's say, of 56, who do not have enough assets to overcome the minimum, the likelihood that they will eventually be able to do this is lower, because they just have less human capital, they have less remaining working life years, okay? Then we look into the counterfactuals when we strip these differences in portfolios, one difference at a time. So here the important result is that diversification matters a lot. Okay, if we remove the diversification benefit, the welfare gains goes down by factor of 3. Bond loadings matter a lot as well. Difference in market loadings almost doesn't matter. Okay, so investors, it's not about getting access to equity index fund. Okay, and then we also find that double glide path matters. So when you do adjustment, also by both age and wealth, okay, it matters for welfare than doing just adjustment by age, what the target date fund does. So let me conclude. Do less wealthy participate in robo-advice when it becomes less accessible? The answer is yes. We don't find effect on the poorest investors though. So those who have less than 1K in investable assets, they do not invest with a robo-advisor neither before nor after. And you know, when people think about inequality, how does the access to professional assistance helps, right? So you might think that middle class will do better probably relative to the upper class because now they have access to professional assistance. But at the same time, the poorest investors, you know, the lower class, let's say, they are not getting anything, okay, from this reduction and from robo-advisors. So it's not clear what would be the overall effect, right? The middle class can catch up with the upper class, but the lower class will is still going to be behind. And in fact, in this range of the wealth distribution, inequality can even increase, okay? And then we talk about what drives demand. This is the optimal response to differences in portfolios. So that's all what you need to explain the response of the investors. And the moderate, welfare gain is moderate, 1.5 percentage point increase in equity. Okay, that's all I have. Thank you very much.
So good morning, everyone. Thanks for having me. Thanks for this wonderful conference so far. Thank you for the international people bringing good weather to Canada in November. Very rare, so I'm very happy about that. My name is Michael, and I had the pleasure of reading and discussing this paper. So really like the paper, really neat analysis, great data. I really appreciate how upfront the authors were about everything, so we can have a very honest discussion about it. In one slide, the question that they try to ask in this paper is, how do robo-advisors affect less wealthy households? And they have this approach where in the reduced form side, they use a really neat data and this very clean exercise difference and difference to estimate the change in use of robo-advisors from this experiment where all of a sudden the advisor said, we're going to lower the account minimum from $5,000 to $500, one-time reduction, and they have these unique data sets we'll talk about in a second. Now on the structural side, they take these reduced form estimates and they say, okay, we have these estimates and we want to understand the welfare gain. So we build this life cycle consumption model, and we're going to study in the model how does welfare change, and then we can look at how does it change for different groups of people. So I thought that was really neat. The main findings are, the share of robo-advised households in the middle class, so the second and third wealth quintiles, increased by 16 percentage points, which is 107%. That's a sizable increase. And then in the model, we can send that and say, well, we increase welfare for everybody by 0.8% of annual consumption. And then the main dimension along heterogeneity was really age. So for the oldest people in the sample, we saw that it increases by 1.7%, which is almost double. The reduced form analysis, I really have no major complaints. I think it's very, very careful, very, very compelling evidence. What I really appreciated as a reader was that they state all of their assumptions very clearly, both technically and econometrically. So you can see the intuition and the math behind it, and you can make your own assessment about whether you believe what they're saying. Now, the main mechanism for the democratization was that these middle-class households, they don't really have the liquidity on hand to invest $5,000, or they might have that, but if they were to put all of that into the robo-advisor, then their share of how much they'd be in the equity market is too high. So they might have the liquidity, but they don't necessarily want to put all that into the robo-advisor. So when you lower the minimum, then you allow them to participate in the robo-advisor. And the real piece of evidence for this was that in table 1, and this goes back to your comment, was 55% of existing middle-class households, they bunched their initial deposit at exactly $5,000, but then afterwards, 66% of new participants make a deposit under $5,000. So I thought a really compelling figure, kind of like a first stage, would be to show, a histogram of how much were the initial contributions, both before and after, and then other cuts of the data like you were saying, to maybe compare across how does that change. So I think this will just kind of emphasize this main mechanism, but I think it's very plausible, and it passes the sniff test. This is kind of the key figure. All I would suggest for this was to kind of put the numbers somewhere in a table in the paper, because the headline number in the paper was, I think, 16 percentage points, and then in presentation it might have been 15. And here what you really see is that it's really this group and this group where all the action is coming. So this group, there is a little bit. This group, it jumps up a little bit. Again, it's still very consistent with the story, but it would be nice to see these numbers and maybe think a little bit more about, what's really special about this group versus this group. And one story might be that we know the SCF, like these quintiles are not even at all, right? This is a huge, huge gap. So because you have so much data and because you're using the SCF for these cutoffs, you could look at more groups and maybe kind of find a way to understand, well, why is this jumping up? But overall, really, no complaints at all about the empirics. Now, the structural life cycle model. So they take CGM 2005, very standard model, it's been used, it's been abused, and they enrich it with this third investment choice, which I think makes a lot of sense. You have your risk-free bond, your self-managed portfolio, now you have this robo-advisor portfolio. The robo-advisor is really different from the self-managed portfolio because they have this really rich factor model. And I think that really emphasizes one of the key benefits of their data is that they can observe the counterfactual portfolio for some of these robo-advisors. So we all talk about selection. We always wish, we wish we could observe what would people have done did they not have this option. And for a subset of people, and I think a large subset, a convincing subset, we can observe. So that's really, really, really rich. I think that's a huge benefit of this data set. And then as they carefully study the implications of this, they find that most of the benefits come from the robo-advisor having this double glide path, and especially on the dimension of wealth, because you have target dated funds that will glide you along age, but then the joint distribution of age and wealth is really where most of the benefits come in. So I have 3 model comments because I thought that the welfare analysis was fantastic, but like Stas was saying, it kind of understates what we think might be happening. And the first is that in the model, once you retire, you no longer have any labor income, and there's no more uncertainty. So now you're just solving the standard cake eating problem. You have the cake. If you're me, you eat the whole cake on day 1. But if you're more intelligent, you kind of spread it out over more time periods. So does this really happen in the data? I believe the answer is no. And if not, then the retirement choice, modeling it this way, will understate the benefits, especially for old people. And we know from figure 6 that older households, they benefit more from the reduced minimum because like Stas was saying, they wake up one day and everybody has access to the robo-advisor at $5,000. If you're 20, you have a lot of time to accumulate wealth and join the robo-advisor. If you're old, you don't have a lot of time. On the other end, if you're old, you don't have a lot of time to join, but then once you join, the benefits end discreetly as soon as you retire. So extending the participation further on, which I think is realistic, will increase welfare gains for everybody, but then especially for old people. Secondly, this is a comment on this paper, but also lots of papers do this. The way that they set up the experiment, so what they do is the following. They look at the policy function from the model, and they compare it. How does a household with a certain amount of wealth at a certain age invest with a $500 minimum, and then with a $5,000 minimum? And then they construct the weights externally from the SCF, and they multiply this internal with external estimate, and they compare the theoretical effect before and after the policy change. So I say policy change because I'm a central banker, but policy change here is the change of the robo-advisor. And here, they're very upfront about this. Why did they do this? And this is Francisco's survey paper, so lots of papers do this. They begin with the actual wealth distribution, and it matters because in the model, we know that people are very rational. There's no myopia, they're very, very forward-looking, and they accumulate wealth exactly like a rational person would, which we know might not be the case in real life. So what's an alternative methodology? Well, one, and we saw this in papers yesterday, for example, is that you target model parameters to match the relevant cross-sectional moments under the original policy of $500 as the minimum, and then you simulate the same model with that matched or targeted calibration, and then you see, well, does it match the model for the 5,000? And they already have a spirit of that in the figure that Stas showed. And why does this matter? So the current methodology adjusts for this aggressive wealth accumulation by saying, well, we have the dynamics for the individuals, and then we're not going to take the distribution from the model, we'll take the distribution from the data, and we'll look at that. Now the issue with this is that the policy functions are still incorporating that aggressive wealth accumulation, right? The people in the model with their policy functions, they still want to save a lot of money. So when you lower the policy, although you're adjusting in the exercise for where they're going to end up, they still want to save aggressively. They still have this very, very long horizon planning problem, and they're still solving this perfect problem. Even if you correct for that in distribution, you're going to understate the welfare gains because these households are still very aggressive savers. So you're kind of solving part of the problem, but I think, again, this will kind of help your results because the agents in the model, when you offer them the robo-advisor, they're saying, okay, this is good, but without the robo-advisor, I'm still doing pretty well. So you partially correct for that, but I think this is obviously a different exercise. Now, for your main analysis, this might not be super important. What I think it's really important, and this is my final comment, is about the source of funds to the robo-advisor. So what are the options that the agent has? You motivate the paper by saying, there's 2 things that we might be interested in. First, we have some households who already have access to some kind of managed fund. Maybe they're sophisticated and they buy an ETF or a target date fund. And now, if you have a robo-advisor, you can invest more efficiently. Now, secondly, I think more interestingly, is automation may enable people who had no access to professional wealth advising at all. And then those people, they can now benefit from, well, all of a sudden, I only need $500 and I can have a robo-advisor. It's like the democratization of what I like about that is that, I have the same phone as Bill Gates. There's no real difference in it just because an iPhone is cheap for everybody. So how does this map to the model? Well, roughly speaking, the first point here, we're trying to look at who goes from self-managed to the robo-advisor, and the second is asking who goes from the risk-free bond, which is like no equity market participation at all, to the robo-advisor. So this is kind of a rough mapping because there isn't really anyone in the model who doesn't participate in any way, because the risk-free bond is still some sort of a wealth accumulation. It's not like there's anyone in the model who's completely hand-to-mouth. Now, the contribution to the structural model, the beauty of it is that you can ask by looking at the policy function, well, when the minimum decreases, how do the portfolio share decisions change? So to me, it seems that the modest gains suggest that it's mostly self-managed to a robo-advisor. And that's why the benefits are positive, but they're relatively limited. You're having people switch from a decent portfolio to a better portfolio. But you're not having many people switch from no portfolio at all to a much better portfolio. Now, the relevant question, and this is related to yesterday, I added these brackets because I have the benefit of presenting on the second day, is does the reduced minimum induce investment from those who are currently not participating in equity market at all, with the caveat of do we want it to, right? Are people oversaving? Let's presume that we want it to. Now, we consider, to get at this point, the authors consider this model with the cost for the self-managed portfolio. So here what they're trying to do is say, let's push more people away from the middle group of investing in the equity market, and let's have them not participate at all. And then let's see when you reduce the minimum, where does that push them? And what are the welfare gains from that? And what we see is that the welfare gain is 1.23% for the pooled sample versus 0.8%, and that's for a participation cost of $200 per period. Okay? So this implies that there's more switching towards the robo-advisor, and it can come from one of two places, right? It could be that the mass of self-managed, the people who are investing in the stock market but not the robo-advisor, that stays the same, right, or roughly the same, but they're incurring this cost. So once you lower the minimum, these people switch from self-managed to robo-advisor, and the welfare gain is coming from the fact that the portfolio is better, plus every period they have an extra $200 in their pocket. Second place it might be coming from is that the cost, it pushes the mass of people to not participate in the equity market at all. So you're pushing from the middle group to the no participation group completely, and then you're kind of switching to the robo-advisor. So this is an interesting group to me, right? You have an ordering of 1, 2, 3, from risk-free, self-managed to robo, and it could be that this participation cost is indeed pushing people from 1 to 3, which would be addressing kind of that second point about democratizing wealth management for people who are not participating at all. Now, you can't study, they don't really go into too much detail on this, but what you can see is that when they increase the cost to $700 per period, the welfare gain is almost identical. It's 1.24%, and the only difference is for the oldest people goes up by 5 or 6 basis points. And this suggests one, right? And what this suggests is that it really is just they're self-managed people who are managing their portfolios themselves. They're willing to pay the cost, and when the robo-advisor comes in, it pushes them from self-managed to the robo-advisor. And that's where the welfare benefits are coming from in this case. They're just not paying the participation cost. So I think that they're really answering the first of their two motivations. And the second would be to ask, well, do we want people who are not invested at all to have access to robo-advisors? And then what are the welfare gains from that? And I think a long way to going that would be exploring more this extension model with a participation cost, because I want to see a figure that has the 3 groups, and who is self-managed, who is risk-free bond, who is robo-advisor, and then how does that change? And really that's the beauty of the structural model. I think their headline welfare numbers are, they say modest, I think they're very impressive, honestly. That's a for an essentially Pareto improvement, that's a big welfare gain. So I think it's not modest at all. And I would suggest that focusing a little bit more on how can we think about people in the model who are going from no participation to robo-advisor, what are the welfare gains from that? So that's all I have to say, and thank you all.
Thank you, Michael, for your comments. So, on the defined contribution plan, nothing to say. I mean, we are doing that. I mean, if you look into the paper, the table in the paper says defined contribution plan TBD. Okay, so we are kind of it's in work, right? This is like comment 1 is completely valid. Okay, we cannot do it the cake. It's too simplistic. We need some retirement plan. We are working. This is something that we need to finish that one. The last thing that we need to finish before we move on. doing the simulation instead of calibration, so simulating what happens after that, I think that's also a good point. We can do it. I mean, there's not too much to say about that. Then, when it comes to stock market participation, so we initially, what we did in one of the early versions of the paper, we built a machine learning model where we tried to predict the stock market participation status of robo participants, okay, based on the SCF data. And we were trying to really understand these questions. So whether there is a genuine shift in stock market participation versus from already having some risky assets and just transitioning to different portfolio. And then because of the fact that we had to make more assumptions, we just decided to sort of pull back and to say, well, we will assume that they all have something, because if some of them have nothing, that welfare gains can be even higher, right? Because you move from risky bond, from riskless bond to into the risky asset. But I mean, we can review it once again. If you think that this is valuable, we can take a look at the stock market participation as well. Yes?
One thing I'd love to do, see, and this is coming as someone who would be a sympathetic referee, so they're the ones you want to pay attention to if I can. Even if I would have minor carps about aspects of the model, I'd love to see you expose the welfare calculation much more explicitly here. I spent a lot of time in Appendix D, and I love what you're doing there, but I'm deeply suspicious. Not that you've done anything deliberately to mishide things, I just can't track down the key numbers. So the two things I would look for here, give me a translation in that figure 4 between this cryptic voodoo Ouija board called risk tolerance to something called relative risk aversion. If you're familiar with that concept, there is a map to them actually. You can't figure that out. Then, in your simulated model, be very explicit about what risk attitude is being assumed or implied by what you're doing. And then maybe you've got this very nice table 9 where you do robustness checks on the welfare thing. That's a place to put a little robustness check in there. What if instead of going, we pulled a number from the literature, we actually calibrated the relative risk aversions to hit what was actually there, what would be the welfare effects? Because I think what you've done there, again, even if I would carp about little things here, I want people to do the welfare calculation clearly. Okay. Long appendices are fine, and I think you've done everything okay, but I want to just see it without having to do mountains of work to guess at what you've done.
Okay, fair point. Okay, thank you, Brian.
Awesome. So I would just move on.
Thank you very much.
Yes, thank you.